The world's central banks have been on a gold buying spree this year, raising concerns maybe they think something big is coming. In raw numbers, gold buys by central banks are up 34% on the previous year, taking central bank gold holdings above the pre-Nixon record, which is a big deal. Buying has been torrid from both rich countries and poor, so the top buyers were China, Singapore, Turkey, and India. Even the Europeans are buying, more on that in a moment. Now, one of the best kept secrets outside the gold community is that central banks have actually been buying gold ever since the 2008 financial crisis. In other words, whatever reassuring press releases they put out, their behavior says they are worried. So first, what does buying gold mean? So central banks hold a variety of assets to park their money printings without losing money and sticking taxpayers with the bill. I mentioned in a recent video that both Sweden, Britain, and our own Federal Reserve have failed spectacularly at this, losing money and leading to bailouts in Sweden and Britain, whilst the Federal Reserve is running a negative $120 billion tab with Treasury. Normally, central banks invest their thieving money printings in government bonds, partly because there is no honor among thieves, but also because there are so many government bonds, we are drowning in them, that they make up the most liquid markets in the world, meaning it is a lot easier to move $1 trillion in and out of bonds than, let's say, real estate or corporate debt. Thing is, for a long time, the one asset that got no love from central banks was gold. Ever since President Nixon closed the gold window in 1971, essentially killing off the worldwide gold standard, central banks have been ditching the yellow metal that used to stand as the ultimate guarantee of solvency. But now, after a decade of nonstop buys, which is now apparently accelerating rapidly, what do the central bankers know that they're not saying? Well, we actually found out last week in an interview with an official from the Dutch central bank, one Ert Huben, asked why the Dutch central bank was hoovering up gold to the tune of now 4% of GDP. He responded that gold is very useful as a backstop in the case of financial collapse, adding that most European central banks are doing the same thing. As he put it, quote, "If everything collapses, the value of gold skyrockets, plus you don't have to cover it." In other words, not only is gold insurance for central banks in case they manage to collapse the entire global economy, they're also very much aware that it does not take much gold to restore a gold standard. That's the cover bit that he mentioned. I have talked about this in recent videos, how a gold standard is actually much closer than it looks because existing central bank gold holdings can actually support a full gold standard. The reason is that if the market trusts you to redeem your gold, then it also trusts you to keep inflation low enough that you won't have to. Pair that with a soaring gold price, which remonetizing gold would do, and it's surprisingly easy. So what's next? Brought to you by Unchained. When the central bankers are panic buying insurance, you know it's bad. Still, central banks are still at the insurance stage, not at the implementation stage. But if government spending keeps pushing higher and higher inflation, which seems a fairly good bet, then we will see more and more countries losing control and cashing in their currencies for something harder, whether that's poor countries going to the dollar, as with El Salvador and perhaps Argentina, or rich countries going to gold. Okay, we'll be watching. See you next time.